Back on the phones, here is Monaco, who's in Toronto. Good afternoon.
Good afternoon, gentlemen. Great show.
Thank you.
Great guest. I've done very well with Enbridge since March '09 lows. In that time frame, why has Enbridge outperformed its sector? And what are the primary risks going forward and potential corresponding percentage drops in its price if it breaks down?
Well, Monaco, I wish I could tell you all of those things, but why is it that they've done so well? So this is a great study in buying the leader within a group at a time when the group has been out of favor. So when you came into this bull market, going back to 2009, this was a sector that was generally unloved. People did not see the boom in oil and gas production coming necessarily in North America. But Enbridge had been executing really well. Enbridge is a remarkably disciplined business. They look at every potential new project that they build based on what kind of return on the capital that they can get. And they had a lot of long-term projects sort of lined up to build. And they've continued to be that way. Often when an industry booms, companies become less disciplined in a land grab to try and grab as much business as possible. Enbridge has continued to be very methodical in the decisions that they've made toward building out new capacity. So they continue to do that. And often the leader or the highest quality company in an industry trades at the highest valuation. They always look expensive, but they very often are consistently beating the numbers. And so Enbridge has just shown that they're willing to do that. As we mentioned, we think there's a long runway for the energy infrastructure companies, and Enbridge will participate in that. You know, it's one of the larger names. You know, the growth will not be as rapid as it is in some of the midstreams, but I think it will continue to perform well. And remember what people are willing to pay a high value for today. It's not the highest growth, it's not rocket fuel. They're willing to pay for predictability. We got our clients are all people who are looking for a rising stream of income, and Enbridge is in the perfect place to continue to deliver that.
We will stick with energy. Here's Dennis, appropriately enough, in Calgary. Hi, Dennis.
Yes, hi. My question for David is on Bonavista Energy. I'm starting to try to assemble a small basket of mid-cap to large-cap natural gas shares, and I'm just wondering what your opinion of Bonavista Energy would be. Thanks very much.
Well, Dennis, I'll start by saying I haven't taken a close look at Bonavista recently, but what I will say is this. One of the things that we watch for when a sector has been doing very well is for those companies that start to underperform early. And earlier in the summer, natural gas stocks were having a very good run, and if you look back at Bonavista's share price in June, July, they really started to back off. They have underperformed coming into this little rally in energy. They have underperformed going through the rally, and now they are underperforming and started to sell off early. So when I look at the market signals, that tells me this is not one of the leaders in the group. We have backed off our natural gas exposure. Who knows what winter will bring? I think a lot of people think it'll be cold, but there's a lot of natural gas out there. So this is one I don't think that I would chase after. It's not behaving the way that it should if you think things are going really well.
Lots of questions lined up here for David. Let's keep it going. Mark's in Brampton, Ontario. Hi, Mark.
Hello, gentlemen. Can David tell me when we can make some money on this potash here? I've owned it for 3.5 years. I bought it at $48, and I'm still underwater and waiting. Thank you.
So, Mark, we tend to have long cycles where commodity producers have pricing power, and at some point you go through a watershed and they don't have as much pricing power. I think 2012 marked the beginning of a revaluation of paper assets, equities, and a revaluation lower of hard assets. Commodities have underperformed since then. They're showing no signs of changing. If you look at the price of wheat or the price of corn, they've absolutely been cratering this year based on big production. There's going to be big harvests this year. And because pricing is weak, farmers are less likely to spend lots of money on potash. Potash has global competitors who have come in and who are offering product at lower prices. So we're one of the top picks today we're going to talk about is one of those price takers that I talked about earlier that benefits from weaker commodity prices. I don't think you should look through the lens of the last 12 years where we were in a bull market for commodities. These commodities could be weak for some time to come, and I think you want to look at the companies that benefit from low inflation and weaker prices. I would not buy potash here.
Okay, into transportation. Here is Cy, who's in Regina. Hi there, Cy.
Hi there. I'd like to know from David what he thinks of CP Rail and can see in the future if that stock is going to split.
Right. So I have no idea, Cy, whether the stock's going to split or not, but here's another great example of a company benefiting from the current environment. You have an improving business environment in North America. It's not roaring, but it's slowly improving. CP moves a lot of stuff. The transports are hitting a new high, which tells you the market believes the economy is slowly getting better. They are a big beneficiary of lower energy prices. Transports, of course, one of their big input costs, energy. And so, for instance, airlines in the last couple of weeks and the rails are behaving remarkably well. We own CP, we own CNR, we own UNP, we own some airlines. These are companies that benefit from this boom in energy production.
We are taking a short break here with David Burrows. When we come back, we'll be talking some other stocks, such as Talisman. So stick around for that.